Stop. Close the other tabs. Put the phone down. What I'm about to say is not commentary and not speculation. This is a logistics signal that hit internal channels before dawn and never reached the media layer. At 6:08 a.m. Hong Kong time, a message was forwarded to me from a shipping risk desk. One line. January 1st, export status changed to restricted. No explanation, no press release. Just a status flag that instantly alters how metal moves across borders. While the world was celebrating the new year, China quietly closed a gate. Not with an announcement, with paperwork. I saw the circular. It wasn't labeled embargo. That word scares people. It was labeled Adjustment to Strategic Materials Export Alignment. That language only appears when something is being withheld without saying it's being withheld. The event is simple. As of January 1st, outbound silver flows from key Chinese refiners and bonded warehouses were reclassified, not banned, reprioritized. Domestic demand first. Strategic partners second. Open market last. If you don't understand why that matters, let's count together. China is not just a miner. China is the refining choke point. Roughly half of global silver refining touches Chinese infrastructure at some stage. Even silver that is mined elsewhere often passes through Chinese processing, alloying, or intermediate manufacturing before re-entering global trade. When that system changes status, supply does not disappear instantly. It slows. Then it backs up. Then it vanishes from the spot market. I saw the shipping data. In the first 72 hours of January, confirmed outbound silver shipments dropped by more than 38% compared to the same period last year. Not forecast, actual booked tonnage, canceled slots, deferred containers. My sources in the logistics desks were blunt. This isn't about price, it's about control. Domestic solar, electronics, and strategic reserves were given priority codes. Export orders were pushed into secondary queues. Now, the math. Global silver markets run on just-in-time flows. There is no massive buffer. The visible inventories everyone quotes assume continuous replenishment. Break the replenishment, and inventories become optical illusions. COMEX inventories look stable on paper, but registered versus eligible matters. Deliverable versus theoretical matters. And most importantly, where the metal is geographically matters. Silver sitting in Asia does not help a delivery request in New York or London. Here's the number that should make you pause. At current global consumption rates, a sustained 30 to 40% reduction in refined silver exports from China creates a deficit that visible inventories can cover for weeks, not months. Weeks. That's why March matters. Industrial users don't buy headlines. They buy forward coverage. When procurement desks realize flows are tightening, they don't wait for confirmation. They front-run scarcity. I saw the procurement memos. They started circulating quietly before Christmas. Increase safety stock. Lock in Q2 deliveries now. Accept higher premiums. That is not panic. That is professional behavior. At 6:21 a.m., a follow-up message came through. LBMA spot premiums in private transactions widening. Not on screens, off-screen, bilateral deals. That is always the first place stress appears. The media won't cover this because nothing dramatic happened. No ships were seized, no sanctions were announced, no speeches were made. But systems don't respond to speeches. They respond to flows. This is the decoupling phase. Screen price stays calm. Physical availability tightens. Premiums detach quietly. Let me explain the mechanism in plain terms. Imagine a warehouse that supplies a city. The lights are on, the shelves look full, but the loading dock is closed half the time. Customers don't notice immediately, until restocking stops. China didn't turn off the lights, it slowed the dock. Why now? Because silver is no longer just a metal. It's an input into energy transition, defense electronics, and strategic manufacturing. When internal demand curves cross external obligations, exports lose. This is not ideology, it's math. I saw an internal demand projection from a large Chinese industrial consortium. Domestic silver consumption growth outpaces mine supply growth. That gap has to be filled somewhere. The easiest place is exports. Now let's talk about what the market assumes incorrectly. The market assumes that if price rises, supply responds. That works when supply is elastic. Strategic supply is not elastic. It is administrative. When supply is controlled by policy, price signals arrive late. By the time screen prices reflect scarcity, procurement desks have already locked inventory. Retail sees it last. That's how silver disappears without disappearing. It doesn't vanish. It gets allocated before you can see it. One more data point. Freight insurers quietly adjusted risk premiums on precious metal shipments originating from East Asia starting January 1st. That only happens when underwriters expect disruption. They don't guess. They see filings. This is not a trade war headline. It's a quiet reordering of priority. Now the critical question, why March? Because that's when forward contracts roll. That's when industrial users need physical delivery, not paper settlement. If the metal isn't where the contract assumes it is, something has to give. Either premiums explode, or settlement terms change, or deliveries are delayed. All three are forms of stress. My sources in the trading desk used one phrase repeatedly this morning. Screen price is no longer the price. That is the warning. When physical flows tighten upstream, paper markets keep trading until they can't. Then rules adjust. This is not about China versus the world. It's about any country choosing internal stability over external supply. China just happens to be the one holding the gate. If you are watching headlines, you will miss this. If you are watching flows, it's already happening. At 6:34 a.m., the last message I received said this. Expect visible impact by late Q1 if restrictions persist. Late Q1 is March. This is not a prediction. It's a timeline based on inventory turnover and shipping lag. When silver becomes scarce, it doesn't ring a bell. It just stops being offered. And by the time everyone agrees it's gone, it's already allocated to someone else. Listen carefully. This is where narratives collapse and mechanics take over. What happens after the gates narrow determines who adapts and who is priced out. There are only 3 outcomes from here. Not 5, not a spectrum. 3. I've seen all 3 mapped in internal logistics stress models. One exists only to calm people. One transfers losses fast. One drains the system slowly. The first scenario is the unicorn. Everything reopens. Export priorities quietly normalize. Shipments resume. Premiums compress. Screens look calm again. This scenario is presented publicly to buy time. Internally, it carries a probability of 0. Because once a supply gate is administratively tightened, it is not loosened without a strategic reason. No one reverses a restriction just to be generous, especially not when domestic demand is rising. The second scenario is the hard break. Functional default in the physical market. Not a headline saying default, but missed deliveries, rolled contracts, and forced cash settlement. Exchanges remain open, paper trades clear, but physical obligations are modified, delayed, netted, repriced. The market continues, but the promise changes. This scenario shows up when inventories are drawn down faster than replenishment. At that point, rulebooks do the work. Force majeure language activates. Settlement terms adjust. The exchange survives. Participants absorb the difference between what they expected and what they receive. Internally, this path carries about a 60% probability if restrictions persist through the next contract cycle. Not because it's dramatic, because it's efficient. The third scenario is the one most people miss because it doesn't feel like a crisis. Slow suffocation. Supply remains technically available, but only at rising premiums, longer lead times, and tighter conditions. No announcement, no panic. Just fewer offers, smaller lots, and more subject to confirmation language. This is how scarcity is rationed without headlines. Industrial buyers lock supply early. Private deals move off-screen. Public markets keep quoting reference prices that fewer and fewer people can actually transact at. This scenario stretches over months. It's survivable for institutions with access and relationships. It's brutal for everyone else. Now indicators, not opinions. Signals that tell you which scenario is unfolding. First, watch COMEX inventories, but not the headline number. Watch registered versus eligible. Registered metal is deliverable. Eligible metal is not obligated. When eligible stays flat and registered drains, delivery pressure is rising, even if total inventory looks fine. Second, track premiums to spot and physical markets, not ETFs, not futures spreads. Real bars, real coins, wholesale transactions. When premiums rise while screen prices stay calm, the paper market is lagging reality. Third, pay attention to contract language changes, margin adjustments, delivery flexibility, expanded cash settlement clauses. These changes always arrive before stress becomes visible. By the time they are explained publicly, they are already active. Fourth, monitor failures that appear unrelated. Refiners with maintenance. Logistics firms with temporary disruptions. Smaller brokers exiting metals quietly. These are pressure vents. Stress is moving through the system. Fifth, watch industrial behavior. When manufacturers start talking about inventory security instead of price, scarcity is already priced internally. Retail hears it last. Now strategy. This is not about fear. Fear leads to bad timing. This is about positioning before options disappear. First principle, paper exposure is not physical access. It is a financial claim. Claims settle under rules. Rules change under stress. Second principle, do not expect price signals to warn you early. In administratively controlled supply chains, price reacts late. Allocation happens first. Third principle, separate what you own from what you are promised. If access matters, dependency on a single system is risk. This does not mean abandoning markets. Markets are useful, but understand their role. Paper markets are price discovery tools. Physical markets are allocation mechanisms. Under stress, allocation dominates. Internal allocation guidelines I saw repeatedly converged on the same range. 20 to 30% of net worth in assets that are not subject to rehypothecation, substitution, or delivery discretion. Not optimized, not traded, held. Physical versus paper is not a belief system. It's a hierarchy. Paper sits inside policy. Physical sits outside. Avoid leverage. Leverage converts supply tightening into forced action against you. Margin terms change faster than you can react. When supply tightens, leverage ensures you lose optionality first. Avoid concentration. Multiple products tied to the same clearing or sourcing infrastructure are one exposure. Diversification only works across different rulebooks. Maintain operational liquidity, but understand its limits. Cash is flexible until controls appear. When controls appear, cash becomes a permissioned asset. Most importantly, stop outsourcing responsibility for access. Custodians manage systems. They do not absorb stress equally with clients. When trade-offs appear, asymmetry becomes policy. Let me be clear. This is not a prediction of collapse. It's a description of how systems behave when flows tighten upstream. China did not need to announce anything. It only needed to reprioritize. Silver does not disappear overnight. It gets allocated quietly. By the time scarcity is obvious on screens, the metal is already spoken for. The key mistake people make is assuming visibility equals availability. It does not. Visibility is reporting. Availability is permission. I've watched this play out in energy, shipping, cash markets, and metals. The pattern never changes. Control comes first. Price adjusts later. The final warning is the same one that closed more than one internal briefing I attended. Better to be early by a year than late by a minute. Because when the minute arrives, you're no longer choosing. You're being processed by a system that has already decided who gets supply and who gets settlement.